Welcome to another episode of the Bank Free Blueprint. And today I have with me Brian Darcy. Welcome, Brian.
Hi, thanks for having me. Appreciate it.
Absolutely. So you and I have known each other for 5, 6, 7 years now, and I've always known you as the apartment guru. I know that you do a lot of syndications of apartments, and I believe you started out of the tech world. You were an executive at a software company, software medical device company.
Yeah.
And decided that real estate might be a good option for you. And it sounds to me like it's been quite good at 2,200 units roughly over the last 6, 7 years. That's $80 million in real estate transactions. That's quite the accomplishment. So congratulations on that. So what I'd love to do right now is pick your brain and kind of figure out what are maybe some of your secrets or some of your tricks or some of your techniques, maybe is a better way to say it, of that have been made it work for you, that you in putting deals together, and then maybe talk a little bit about the syndication piece of it and how syndications work. So
great.
So let's start with the, just to give a basis for anybody who might be starting out. What is the main reason that you like rental properties, especially apartments?
Well, apartments, because there's it's one roof, many doors.
Mm-hmm.
And so there's an ability for an apartment to handle any kinds of volatility that might come with a rental. Because we all know that rentals are a little more volatile. You lose a vacancy, or you lose a tenant, you have a vacant, and you make no rent during that time period. And the thing about apartments that I like is that with 100 doors or more, you can tolerate a few of those vacancies without really destroying your business, and you can still cover your mortgage and still have a good, strong cash flow.
Right.
I think, what I like about rentals is that passive income, the passive nature of it. I'm not out spinning plates on every single deal. I keep track of it, but I'm not the one punching a clock and making sure that tenants' leases are signed or units are cleaned and all that.
Mm-hmm.
So really, once I put something in place, especially when it's performing well, which is most of the time, but when I put something in place, it really allows me to be more hands-off and thus driving a passive income. So that was really the primary attraction to moving in that direction. Nice. Where I came from corporate, and I had to spend more time. I had to work a lot harder. I don't mind working hard, but I had to work a lot harder, and I was only getting paid so much. And so the only way I could take on more tasks or take on more projects and hope that it would move me into another bracket in the company.
Yeah. So you were hitting
more dependent on my efforts rather than the efforts of the actual asset.
Mm-hmm. Right. Leveraging other things other than just your time because of
exactly
the proverbial glass ceiling that one runs into in the corporate world.
Absolutely.
So with rental properties, one of the biggest benefits of it is that in a way the tenants or the residents, let's call them, are paying for the mortgage.
Mm-hmm.
And over time, the property eventually gets paid for, or the mortgage gets paid down, one or the other. So that's obviously a benefit. Could you just walk through maybe just the very basics of, let's start with NOI, net operating income, that calculation, and then taking it to the cap rates, and just to give a little bit of a basis, and then we'll get into the syndication part right after that.
Sure. Well, the net operating income, or the NOI, is one of the primary numbers, if you are, metrics that we look for when we're looking at a multifamily or any real commercial deal.
Right.
And just back up a second, the difference between single family and commercial is 5 units. So it's single family, 1 through 4 doors. And then anything more than 4 doors is commercial. And so the property is evaluated based on its ability to create a net operating income. And basically the net operating income is simply the amount of money that comes in less your expenses. So Make $1 million, pay $500,000 in expenses.
Mm-hmm.
You have a net operating income of $500,000. So the expenses the income less the expenses creates the NOI.
Mm-hmm.
Now, that NOI is a very important number because it could drive what your price would be for a property. So depending on the capitalization rate for that market, if say it's a 10 cap and I was able to take my property and increase its net operating income over maybe a 2 to 5 year holding period, say $100,000 at 10 cap, that's $1 million in equitable increase. So that's the importance. Pretty technical for a simple show,
yeah.
But it's the importance of the NOI because not only this is how well my property is performing, but it also drives its valuation at resale, and at purchase and at resale.
Mm-hmm. Yeah, and so cap rate is really simply the way I would define it, and you can add whatever you'd like on it, is that cap rate is if one was to pay all cash for a certain property, what would their return on investment be if there was no debt service? Is that how
the cap rate itself? Yeah.
Yeah, so the cap rate.
In a 6 cap market, then you would make 6% basically return.
Yes, 6% annualized return, right? And so to calculate that cap rate, net operating income divided by?
Net operating income divided by purchase price will create the cap rate.
Yeah, yeah.
Right?
Gotcha.
So
and if you want to find out what the purchase price is, then net operating income divided by the cap rate.
By the cap rate. Right. And then that'll create your purchase price. That helps you going in and on the sale as well.
Yeah. So maybe in a different episode, we might get more into those details, like the basics of that sort of calculation. But one other thing you mentioned was the difference between residential and commercial. So part of the reason that the 1 to 4 unit is not classified or not analyzed the same way as multifamily is because of the amortization over or the spread, the number of units in a building. It's hard to amortize something at a duplex or a single family that's going to have any sort of return the same as what anything over 4 units would have.
Yeah, and the evaluation, it really comes down to the evaluation, right?
Mm-hmm.
The single family home or the 1 to 4 units, the residential, a lot of times its valuation is not valued on a cost basis.
Yes.
Right? And so the net operating income drives the cost basis on the multifamily. The thing about the single family, which many of us know, is the value of our homes are dictated, if you will, by the comparables, the sales comparables in that immediate area. So if you have bad sales comparables, you're not going to get a great price. Mm-hmm. The thing I like about multifamily is that because it's based on your net operating income and the cap rate, it puts the control back into my hands. Mm-hmm. Providing the cap rate stays relatively flat, right? But with a pretty even cap rate, if I'm in the position to raise my net operating income, I actually have forced additional equity into that property. Yeah. And that's the game that we play. That's the value add when we talk about, we do momentum plays or value plays. That's the value add to the property because we know that we could get in on something, increase its net operating income, and therefore that results in increased value.
Yeah. Is there a rule of thumb that you go by that, let's say you can raise your rents by $20 a unit? Is there a short math?
Yeah, it just depends if it's depends on the number of units.
Yeah.
I would say if you raise your net operating income and you sustain that raise over, say, a 1 year, 2 year period, you're showing performance. The property is performing.
Right.
And if you show that property performance, and it's say $100,000, and nobody does a 10 cap. I mean, there are very few and far between now. Mm-hmm. But say at a 10 cap, you have put that $100,000 in increased net operating income will equal about 10 times the increased value, which is $1 million in equity. So it's an easy way to look at it.
That's exactly what I was aiming for, because that's the way I look at it too. From a
Yeah.
if you
Now,
do
if you
it,
put now remember that the cap rate goes down, the value goes up, right?
mm-hmm.
That's super important to know because a lot of people, oh, the cap's high, that's a bummer. No, that's great
Yeah,
because
that's
that means your property value is going to be low. Actually, that's the bottom. When I'm buying, it's great because that means the property value is low. But
yeah.
if the cap goes down, now my property value goes up. So you got
Mm-hmm.
to know that seesaw nature between those two metrics.
Right, right. Good. Cool. So what areas do you focus on when you're investing in real estate? I know that you and I have talked about emerging markets, and maybe if you can describe geographically what areas, and then talk a little bit about emerging markets and what that might look like.
Okay. So the areas that I've been totally invested in is Texas.
Mm-hmm.
And it doesn't mean that I mean, I like Texas. It's a good, very strong economical area or economy area. So I like that a lot. The market is very strong. The government's very strong. And the taxes are higher, but that works into the deal.
Mm-hmm.
But I think, from an emerging market standpoint, the predominant thing is really see what is going on in that market um, from the economic. What are the economic drivers? Is it a path of progress? Are there new jobs, new industries coming into there, or are there very stabilized industries already there? We being in Texas, we have been impacted negatively in the past by oil, but we've also been impacted significantly in a positive way by oil. And but if we go into a market and the only thing is one thing, like oil, for example, and when oil goes down, then your market disappears. It becomes a ghost town.
Mm-hmm.
So we want to have a very diverse market with strong education, strong maybe a government seat for a government seat for the county or for the city, that kind of thing.
Mm-hmm.
And also to have companies that have been there for a while, make it attractive for business. So there's good incentives for businesses to be there.
Mm-hmm.
And so that's one of the reasons why we're still in Texas is because I feel like Texas and cities like San Antonio and Dallas, that they're just in still mass explosion mode. And companies are moving their whole headquarters there and
Mm-hmm.
branches of their companies there. So that's the kind of thing we look for. And then we do, excuse me, we do symbiotic marketing, if you will. If big box retail is going there, you watch the Home Depots, the Lowe's, the Starbucks come a little bit later, but you
Mm-hmm.
watch the Home Depot, Lowe's, Super Walmarts, and when they're building new places in those cities, those are things to watch. That means something's happening.
Yeah.
The thing about an emerging market, and I've done entire webinars on just emerging markets, but emerging markets go through cycles. Well, markets go through cycles, and you want to catch that market when it's kind of in its down cycle, either near the bottom or just bouncing off the bottom, ideally. This is
Mm-hmm.
the wealth builders. And that would mean the market's recovering somehow.
Mm-hmm.
And it's recovering from some sort of an economic oversupply or something like that. And as it bounces off the bottom, that's where we want to buy in because that's going to be the one that's going to make us the money. And then it emerges, and as it emerges, jobs come in. There's new jobs, new freeways, new big box retail, and then all of a sudden, as it starts to move up that cycle of the market cycle, you start to see more apartments. That the supply as exceeds the demand. And so what happens is now brand new apartments start to come on. There's lots of new building permits brought on. And now remember, those take 5 years to build,
Mm-hmm.
probably to build an apartment. So by the time you go through permitting and all that. So permits start to get pulled, units start to come online, and then you start to see your absorption numbers start to come into play. Now you're moving towards the higher end of the cycle. And when the absorption is no longer there, that means the supply is higher than the demand, then you go back down the other side.
Mm-hmm.
Now that cycle of an emerging market could be 5 years, 7 years. I mean, it's very hard to predict.
Yeah.
And definitely watch it. And there's some great sources to watch it too.
Mm-hmm.
And we get friends with the local authorities, the mayor, the city offices, the mayor. I always try to meet the mayor in any city that I'm buying properties in. It's a little harder in San Antonio, but
Yeah.
some of the submarkets, it's easier to do.
Oh, for
And
sure.
also the chambers of commerce and things like that. So I try to take as much information and collect a lot of data before we actually purchase in that market.
Okay.
It's all part of our cycle,
Yeah.
our process when we go through an acquisition.
When you, over the last 7 years, 8 years that you've been acquiring apartments and either acquiring and upgrading and just keeping as rentals, or even turning around and reselling them, what have you seen as, or what has been your target, if anything specific, when it comes to the types of sellers that you're, is it tired sellers? Is it repositioning where the property just needs to be brought back to a different, to a higher grade? What would you say? Is it?
Yeah, it's pretty key. I mean, I think it's vital to have a motivated seller. And they might be motivated for multiple reasons. Maybe their partnership is coming to an end. They're out of state. They're tired. Like you said, tired means I'm tired of doing this. So a lot of people take on an apartment complex and then they self-manage it. And it's taking on a job, basically.
Totally. Yeah.
And so now you still got to watch it and you still got to be on top of it. But so they get tired of it, or they're just at the part of their career where they've done what they needed to do and they're, letting their assets go. And the reason it's important for them to be motivated, because now I can negotiate a better deal. If someone's out trying to make a bunch of money and just did a quick flip and wants to make $1 kajillion on that transaction, right? Well, they're not going to be easy to negotiate with. And frankly, in this market, they're likely to get that. Just the way the markets are going right now, I feel like there's a huge demand for apartments, right? And lots of markets, not just in Texas. And it's a lot. So the competition is a lot harder, which tells me we're, closer to that hyper supply market on the market cycle.
When you're getting involved with a project, I imagine like any other real estate project, financing is certainly a big element in the equation.
Yeah.
Is there, so syndication, we'll get into that, and maybe this will tie in, but sometimes there can be some really interesting deals struck by way of either subordinate seller carryback or some sort of owner financing, owner carry, where they carry some of their equity over time. Have you come across that a reasonable amount of times, or is that
I slice and dice deals every which way you possibly can, because based on how that deal is structured, can make something that didn't look like it could work actually work. Yeah. So we strive to go there. I can tell you, I don't have any deals right now that are seller carryback or anything like that. One of the reasons is because if the market is really strong, agency lenders, Fannie, Freddie, will fund those deals. And so seller money is a little bit more expensive than agency money. Yeah. So if I'm going to get an agency loan at 4% or 4.5% right now, that's pretty good. It's almost free debt, right. And probably better than what I could structure seller carry. But I mean, I would look at that. I always look at every possible way. I have a deal I'm working on right now that may be all funded by a private equity fund. And part of it would be a debt structure, or we pay them a debt amount and then 80%. So they would be like a lender, a private lender, as well as the equity holder. So we'd still do an 80-20 so that they would get a fixed return on the interest on the 80% of it. And then on the 20%, they would get an equity return on that. And so it really makes it so they have their cake and eat it too. They have a fixed, clean return, no volatility, and then they have the potential for an equity bump at the back end. Yeah, so that's a great way to structure it too.
It is. Yeah, we've been able to do that a couple of times with our real estate fund too, and that just it creates a great balance of the stability of the first position 80%, but also allows for some of the upside.
Yeah, and for the most part, most of our deals, we have a lender take anywhere 75-80% of loan to value, and then we create private equity sources or bring on equity partners to cover the cost, the closing costs, basically, the down payment plus the closing. And that's usually where when we structure something like that. I don't know if you're going to ask me about that, so I'll just shut up for a minute and let
No.
you let you ask the structuring question.
Yeah. Just on the owner finance or the seller carryback or something having to do with the seller carrying some of their equity. One of the things that I had found, and this was 15, 18 years ago when I was doing a lot of apartments up in Minnesota, one of the advantages to the seller was being able to spread their gains over time. And sometimes that can be another tool. Like you just said, you slice and dice it, right, to make it work. And the more options you have to get it set up so that it really, in the end, is as beneficial as possible for every single player, everybody that's involved with it, the more equitable, the more fair that can be set up, the more likely it is, first of all, that it's going to come together. And second of all, that it's going to hold together and be a really good, solid, long-term, not only investment, but a long-term relationship with more people that you can then build and get more deals from. So
yeah, and it's a strong negotiating point because some sellers, especially a tired seller, you know, they may want out, but the fact of being able to continue to have some sort of a distribution off that property for a longer period of time is actually a good deal for them.
Yeah.
And there might be some tax benefits for them as well if they do that. So they're not taking a big lump sum of capital gains, if you will, at that point in time. Maybe that's deferred for a few years. So we just haven't done that. You know, we haven't needed to, but we talk about it with sellers at times, some, you know, to position ourselves in, okay, do you want to, you know, continue to work in this deal or stay in this deal? Because that's usually the carrot that you get out there, but it just doesn't always work.
Yeah. Okay. So yeah, now in the financing piece of it, let's say we've got a property and we want to do a 100 unit, 50 unit, 48 unit, whatever it is, and we're able to get 70% financing on it, 70% of value, and we want to do a 30% equity investment. Can you describe, maybe starting out with syndication, describe what syndication is a bit, and then talk a little bit about how a syndication or a syndicate might be put together in a situation like this, where there's maybe about 30% that would be needed for an equity piece or cash in, basically.
Okay, well, a syndication, we'll start there. The syndication is basically group funding. It's the ability for people to accumulate their funds to acquire an investment. And there's lots of laws about this, and they're governed by the Securities and Exchange Commission, typically at a federal level. But in California, we also have a California Securities and Exchange Commission. And so there's different laws, but the laws are in place to protect the investor from being taken advantage of.
Yes.
And so the syndication itself, the syndications I do are all within the Rule 506 Regulation D. It's typically almost every syndication we do. And that allows, depends on the type of filing we do, allows both two types of investors, a accredited investor and a non-accredited, or some people call that a sophisticated investor. So depending on the filing we do, the syndication we do, it allows us to take either just accredited or both accredited and non-accredited.
Yeah. Mostly
our offerings are the type of that allows for both. An accredited investor, just a real quick definition, is someone who has $1 million in net worth or makes $200,000 annually for the last 2 years, or 300,000 combined.
Yeah.
That's the basics of it.
Excluding
excluding the equity in their private home or their personal residence.
Right.
Then the non-accredited just doesn't meet that criteria. But we call them sophisticated because you want somebody that they have no concept of investing at all. They've never done anything to invest. They have no clue, and they're going to put their money in their deal and their last 50,000, you know.
Yeah.
And so that would be not a sophisticated investor.
Right.
Now, as a sponsor of a group fund or a syndication, it's up to me to qualify whether the investors are capable or qualified to be able to invest in this. And so I have the responsibility to do that when I'm the sponsor of a group fund. The thing that occurs there is because most of these funds are a security, that's why a syndication is necessary. And a security is simply if someone's investing in something in a passive way with the intent of making money, and there's a manager or somebody in charge of it that is the one running and making decisions for that fund, that's what creates a security. A passive investor and an active manager.
Yes.
And so that's a very short definition of it.
That's great.
Security, and therefore, being a security, you want to do it in a syndication. Syndication comes with a bunch of forms. If you have insomnia, it's nice to sit down with a private placement memorandum. That's the primary form. Yeah. And it's usually about 60 pages
and
of lawyer speak.
It lists all the things that
could go wrong.
Possibly go wrong, which that helps protect you. Now, the reason you can do it, the reason you can be a syndicator without the licensing is that you are an actual participant in the investment.
Yeah, and the other key thing there is a private offering. The typical offerings that we do are a private offering, and so I'm not required to have a securities license because it's private. That means person to person. The people that are in my investments, I have created or have a pre-existing relationship with them before I ever offered them this investment. Yes. And so as a sponsor, we want to be sure that we keep track of that. So if somebody, here's the thing, if somebody just met me today and today I had an offering already open, already being syndicated, that person probably would not be offered what I already have open. Now, perhaps before I have the next investment ready and we meet and I find out what your life is about, your investing life, learn something about you, create a relationship, then it opens up the doors for potential if someone's qualified to be offered that offering.
Yeah. So it's a pre-existing relationship, and the rough rule of thumb, it's not written, but it's a
three-touch rule.
Yeah, 3-touch rule, 30 or 45 days, depending on who you talk to. But the whole idea is to make sure that somebody doesn't get sucked into an investment by someone who's unscrupulous or just does not have that investor's best interest in mind.
Yeah, and then as a sponsor, we might just somebody said to me, "Do you love money and use people, or do you love people and use money?" And so there's a big difference between those two distinguishers.
For sure.
And so that's probably what that's really what a syndication is trying to prevent. People, sponsors using other people just for their money.
Yeah. Now, again, let's go back to the 48 unit or 50 unit complex. That PPM or private placement memorandum, that would typically be one offering for that one project, right? Is that how you do it?
We do that, one offering, one project. I've created a fund before, but it's a lot harder to set up and manage. It's a lot easier to say, okay, I have one apartment complex. We'll use the apartment route. And it becomes a company, usually a limited liability company. And that is set up in where someone can subscribe to that investment. It's called subscribing to the private placement. They could become members of that limited liability company, usually there's a class share, usually a top class, A class, they usually call it, or A shares or A units. There's all kinds of, but they become a member of that company. So the way that it works, just say that 50 unit or whatever. So say it's a $1 million purchase. And that'd be cheap, but okay.
Yeah. Nice round numbers, though.
Well, say a $10 million purchase. Okay. Simpler. And so, so the bank comes in and the lender comes and they provide $7.5 million for that $10 million transaction. It's 75% loan to value. Then the investor will bring their capital to round out the rest of the purchase. So we still need $2.5 million of investor capital. And that's where the investor comes in and invests in some increment, usually $50,000 or $100,000 is the minimum investment in most of my investments. But in some increment, they will subscribe to that investment and they'll become members of the company that holds title to that asset.
Mm-hmm.
So we usually we have to raise the down payment and the closing cost and perhaps some reserves. So, a $10 million investment might be about a $3 million, $3 to $3.2 million investment raise that is needed
Mm-hmm.
on something like that at, say, 25% down, because the costs to close a deal are pretty high too,
Mm-hmm.
So all that's covered. So the way that it is structured then is there are, like I said, there's two shares. There's a management share, which is me, the sponsor, and then there's an investor share, which is when the investors subscribe to that investment.
Mm-hmm.
And then we create what we call a carve out. So typically the investors get the largest percentage of the 60 to 70% of all distribution goes to the investors.
Cash flow and
Cash
profits.
flow,
And
equity,
mm-hmm.
right? And then the 40 to 30% goes to the management side of
Mm-hmm.
it. So that would be my compensation as the sponsor.
And that's for bringing the deal together, being the facilitator, the orchestrator of the entire project.
Right. And, I'm the loan guarantor on every one of my projects.
Mm-hmm.
And most of them are non-recourse loans, but they still require a person.
Yes.
And so if I were to default on one of those loans, I have a lot at risk too.
Mm-hmm.
I wouldn't be able to be a guarantor on another loan, even though they call it non-recourse.
Mm-hmm.
But if you default on a loan, you're almost on a blacklist.
Yeah.
And it'll be a while before you can qualify for another loan. So there's a lot at stake for us as managers.
And that's part of the reason that you're able to get a percentage like that, because you're taking on the risk. Now, if you weren't willing to take on that portion of it, then the percentage likely would be a fair amount lower.
Higher or lower, exactly.
Mm-hmm.
And so the way that we adjust the carve-outs is we try to create a particular return to investors that would mirror perhaps a private note investing,
Mm-hmm.
so that there's a good, strong cash flow to the investors so that they're getting the cash flow throughout the entire, or we project cash flow throughout the entire time. And then based on, remember back to that NOI, the net operating income, based on something we can do to that property to increase the net operating income, we can increase its equity. And then we would, once we hit a target, say $1 million target on the equity side, then we would sell it.
Mm-hmm.
So there's alternatives. We could refinance and pull cash out. There's lots of things, but the carve out doesn't change whether we sell or refinance or anything. The investors are still hold that carve out.
And when you are let's say you're the syndicator or the sponsor of the deal, do you typically set it up that you have a different class of shares, or how do you do that?
Yeah, it's set up as a separate class of shares.
Mm-hmm.
So the A class shares, and it's usually A and B shares.
Mm-hmm.
And the A shares sometimes have a preferred return, not always. Some people say, I want a preferred return. I'm like, trust me, you get a preferred return. We usually pay the investor side first.
Right. Whether it's written or not, it's put
not
in.
Guaranteed. I shouldn't say that. It's not a thing you say when you're talking about syndications, but
right.
We pretty much always pay the investor first. And so it's treated like a preferred return. And some we structure as a preferred return.
Yeah, because otherwise you end up biting off the hand that feeds you. So
yeah, so really a preferred return is just like, say we set a 7% preferred return. That means the first 7% that the property earns in distribution goes to the investor.
Mm-hmm.
And so we kind of like a clean carve out. It's a little simpler to manage and handle, and it makes it fair for everybody, and everybody's happy that way.
Yeah.
So we all own the transact. We own the deal. There's huge advantages in multifamily when you own a real estate asset like this.
Yeah. So now you, as the facilitator, the sponsor, you have the ability to be on both sides, where you can go in with Class A shares, where you're part of the bigger pool of investors by putting cash in as well. So
we're allowed to purchase A shares. We have sometimes. I've even had lenders require that I purchase A shares, being the guarantor of the loan, but I
Mm-hmm.
also hold some of the A shares.
Mm-hmm.
Just about having stake in the game, if you will. Or, it's not always required, and I don't always do it.
Mm-hmm.
We, like you said earlier, we have a lot of risk being the guarantors and making sure that the property performs the way it's, we projected that it would perform. There's a lot of work that goes into that as well.
Yeah. And speaking of work, the biggest challenge with multifamily, or one of the biggest certainly, is the management of the property, right? And so, like you said earlier, many times it's a professional property management company that comes in and does it. But there's also that next level of managing the property management company. Is that part, do you set it up so that's part of your responsibilities? How does that work?
Yeah, I'm the asset manager actually. And so what that asset man, because I'm not the property manager. I used to
Right.
run a large,
Manage the
I
property
had
management.
170 engineers reporting to me. I don't want to do
Yeah.
that.
Yeah.
I don't want employees, but I do manage the asset itself. So from my perspective, I am watching the numbers. I see weekly reports from the property management company, usually the reports that I expect. I give them to the property manager.
Yeah.
And so I know what I'm looking for. I can see, skips and evictions and new leases and pre-lease and traffic, all this stuff I'm seeing on a weekly basis from the property manager.
Mm-hmm.
And then of course I'm watching the financials and the profit and loss statement. And then we're drawing up cash flow every quarter. And so and if I have any capital reserves, which we always have capital reserves, but if I have say a capital improvement project going on something, I'm overseeing that.
Mm-hmm.
As I basically oversee it by approving invoices and things like that. These are typically on a large project that could be hundreds of thousands of
Mm-hmm.
dollars. It's not uncommon
Yeah.
to spend $500,000 or $600,000 on a property to increase its value, right?
Mm-hmm.
So, to increase the rent, increase the value.
Well, and that was kind of where I was going with that question, because one could sort of assume, if one hasn't been through this experience, that you hire a property manager and you check in once every 6 months and
Yeah,
see how
right.
things are. And I know from my experience, and I can imagine from your experience as well, that it takes a lot to manage that, to be the asset manager and to manage the property manager. And so there are a lot of things that go into it, and a lot of time and effort and responsibility that goes
Yeah, I
along
could
with
tell you
it.
there's less time and effort spent when things are really running well. Okay.
Yes.
But if anything goes off, then you got to dig in. For example, I have properties in South Houston.
Mm-hmm.
And so 3 of the last 4 weeks I've been in Houston.
Yeah.
And it's really working with the site, the property management company and the site managers, and trying to project manage this chaos, if you will, and move things forward. Now, that's a lot of effort on my part.
Yeah.
That's not normal, but that's a
Yeah.
lot of effort on my
Right.
part, because it's worth it to bring that asset back to a performing state that I
And that was from the flooding damage from the hurricanes. And you said when we spoke earlier that there wasn't necessarily flooding, but there was a lot of water damage.
Yeah, from windows leaking, lots of soft drywall. In fact, last week I was there, I had a contractor there that demoed 20 plus units.
Mm-hmm.
So down to studs, removed
Yep.
all the insulation and everything. And so they're rebuilding all of that. So, anytime you take a hit like that, it's covered by insurance. Lost rent is covered by insurance typically, pretty much every time. We've had fires, things happen on properties.
Mm-hmm.
And they usually write them, we get them righted and
Mm-hmm.
moving forward. And a lot of times it's almost with no loss
Yeah.
of cash flow. And
Yeah. And to take it full circle, with that property management, with managing that asset, like you said, if it's managed properly, it runs smoother, and it doesn't take as much time maybe, but it's having that very well oiled machine to make it happen so that the rents can be high enough so that they can be top of the market or good, because like you said earlier, we have the the value goes up with every dollar of rent that gets brought into a property. The value of the property then goes up. So it's a full cycle.
Yeah, it's super important to keep tabs on market rents.
Mm-hmm.
But I mean, it's also super important to keep tabs on renewals.
Mm-hmm.
You know, for example,
keeping residents happy.
So if I have, you know, a property I just bought recently, I had, so the rent is say $800. I had tenants in there that were at $690 on the rent. This is obviously Texas, not California.
Yeah, right. Uh-huh.
And so my property manager again said, look, these guys are renewing and they're choking at going to 800. I'm like, put them at 750. Let's keep them. It's better to keep them. So sometimes I have to watch that property manager too, because if they just mandated that everybody that's doing renewal goes to the new market rent, we might lose tenants. And losing tenants costs lots of money. It costs a couple grand on a turnover, and then you don't have vacancy for a period of time until you fill that unit. So you know, sometimes it's better to renew than to have to go through that process.
Yeah. And like any other good project, especially bigger projects, it's so much about the team, about the people working together, the collaboration, making sure that everybody's pulling in the same direction. You help with the property management. You help with all of those aspects to pull everything together to keep it running smooth. Now, that's been really a great explanation. If we go now to the analysis, and we won't go very deep because I don't want to hold up too much of your time here, but you mentioned just a bit ago some sources for finding data, or sources, or I think that's where you were leading to. Can you offer any advice for somebody either who's maybe even seasoned, but certainly somebody who's in the earlier stages of building their portfolio in rental markets or rental properties, any certain sources that you really like to get data from?
Well, I think as far as deal flow comes, you know, it's going to be relationships. That's I think one of the key things about this business, any business like this, it's really person to person. And so building those relationships are always going to open up doors to either new deals or different data sources or what have you. So that's super important. The reason I'm still in Texas, because every time I look out to other states, I'll get a call from a broker and you'll say, hey, Brian, you guys want to look at this one before I put it on the market? Yeah. That's a relationship.
Absolutely.
So once you establish that relationship is super key, and to keep that relationship going is important. As far as data sources, you know, I mean, I try to get into cities. Public data there's so much public data now. Get into the city sites, into the public records, and find out what's going on in that city. You can go to economic development department. It's one of my favorite places to go and see what's going to happen in that city. They usually have a plan. And a lot of times if you go there and talk to the director in charge of economic development for a city, they'll tell you things that I shouldn't tell you this, but I just want you to know that Washington Mutual is going to be establishing a call center in here, you know, and it's a, 100,000 square foot or whatever. Some massive facility, 100, million square foot facility. So you kind of get the inside. So again, it's kind of those relationships, you get face to face is really valuable. If I were to look at data sources, it's not really what I did. There's actually somebody on my team that kind of monitors the data sources, but I really like, just as a simple, quick, it's not exactly cheap, it's still about $2,000, but I really like housingalerts.com. I like that data. I like to see what's happening there. And it's just data, but it's simple to see. We're talking about red light, yellow light, green light. It's that simple.
Yeah.
But it just... And
that's a one-time report typically?
I could query any city, any zip code, you can get down deep into it. And the nice thing about that report, it's quarterly. And the nice thing about it is, as you drill into the data, you could see what's happening there and why is the appreciation dropping, or those kind of things. You could see some of that stuff, and it's just a number. It just makes me go, well, should I be in this market or not in this market? Should I be looking at that market, or should I stay away from that market? So that's one I could think of right away.
And what was that one called?
Housingalerts.com.
Okay. And
It's
what
kind
I'll
of
do is,
spendy. They have a good nationwide site. It's, I don't know, 1,800 a year or something like that. But
okay. So what I'll do, if anybody's listening while they're driving, don't worry about it. We'll put it in the show notes so that you can click on that and get that access to that.
I'll have to
That.
say it's really focused on housing appreciation, but
Mhm.
it's not specifically multifamily. But the value is that those provide indicators
Mhm.
that also affect multifamily markets as
Mhm.
well.
Yeah.
So
Yeah.
basically rental markets.
Great.
So that's one I could think of right away. I could
Mhm.
dig around, see some more, because usually it's get to the city sites, what's happening there. Citydata.com, that's what it used to be called. It has a new site name, but that gives you some demographics for
Mhm.
the area.
Okay.
A lot of broker sites, Marcus and Millichap, I use them a lot, mostly for their multifamily reports for particular cities that I'm in.
Mhm.
They usually monitor, they give good outlook for multifamily. Uh, IRR, Integrity Realty Resources, or Integra Realty Resources.com, IRR.com. Powerful, but it's just an annual report, but it's a really well put together report. They show the market cycles and they show different cities and where they are in the market cycles. It's a great way to understand what's happening or what's projected for that year. I like
Excellent.
that one a lot. I use that at the beginning of the year, but as the year progresses, it's not quite as
Mhm.
valuable, you know.
Yeah.
And they
Yeah.
put out some quarterly reports as well.
But it still could be it's an indicator that's much better than nothing, right?
Yeah.
Yeah.
And then CoStar is a very valuable tool. It's a very expensive tool. It's thousands and thousands of dollars a year. I do not use CoStar. I
Mhm.
use some of the reports. Sometimes a broker will give me a report if I ask. So that is it's really good data as well.
Mhm.
And that's more
Okay.
focused on obviously multifamily and the commercial sector.
Okay. Great. Wow, this has been very very good interview. I appreciate you taking the time on this. You had mentioned just in passing, and I didn't even realize that you do this, but webinars. Do you occasionally put on webinars? Is that something that if any of the listeners want to check out, is that, I don't even know if
Sure.
that's what.
I do webinars usually around the multifamily cycle. Where you pick one thing and, you know, for example, emerging markets is one I did, I don't know,
Mm-hmm.
maybe 5 months ago. I've done simple things like how to invest in a multifamily with you using your IRA, just
Mm-hmm.
your self-directed IRA. Really show, sometimes it's tactical like that. It shows the process of how you move your money out of your
Yeah.
401k into a self-directed and, you know, that kind of stuff and how you can use those things and the benefit of that. I've even done some webinars on very, very tactical metrics on how to crank a deal, structure a deal differently, you know,
Mm-hmm.
more cash, more leverage, and show, you know, how to really increase the value add using stuff like leverage or more cash or restructure.
Okay.
So yeah, it's fun stuff. I try to do one every quarter
Mm-hmm.
and it ends up being about 3 a year
Right. Yeah.
because something comes in, gets in the way.
That's still pretty good. That's still pretty
Yeah.
good. And do you post them? Is that something that would be available to listeners? What would be the?
I usually just host them on a web. We had to use WebEx in the past, and it's just a webinar.
Mm-hmm.
And it's been mostly investors or people that I talk to in my community of multifamily investors, and you know, I mean, and following kind of a local guru, you know,
Yeah.
not local, but a
Mm-hmm.
nationwide guru in apartments, Dave Lindahl.
Mm-hmm.
And so a lot of people I meet in that, usually the way that I start to begin to establish relationship with people is offer up free webinars because
Yeah.
it opens up a door to, and I love giving back. And
Yeah.
so it gives me the opportunity to actually give some knowledge back. And we
Absolutely.
always, my partners and I always focus on our lessons. What did
Mm-hmm.
we learn? Not just what is somebody teaching, but what did we actually learn?
Oh,
Because
so true.
there's some meat there, you know.
So true.
If someone wants to hear it,
Yeah.
because you know
Well,
I don't
much better
want
to
to
hear
learn
it.
lessons over and over again. If I
Much,
learn it
much,
once, I'm going to
yeah,
change something and do it better.
right. So true. And do you archive them, or is that what
I
if
do.
somebody wants
Yeah,
to
I
reach
keep
out
them
to you?
archived. I've thought about, you know, putting a link on our website and things like that. And I just, you know, haven't got
Okay,
to that.
gotcha. So if anybody has questions for you, is there a certain way that they could reach out to?
Yeah, I think probably best is just go to my email.
Mm-hmm.
I don't know if you want to put it up there, on this when you do it.
Sure.
I do have a website that my partners and I have, my Texas partners. So, and it's called, the company that I acquire assets are Innovative Multifamily Investments.
Mm-hmm.
And so our website is imfi.us. So Innovative Multifamily Investments.us. So, and there's a little bit more in there about, I've done a blog or two in there about IRA and things like that. It's one of those things that's harder to keep up, and when I'm in active acquisitions mode and, relatively small team, it's hard to keep. Your website usually gets deprioritized, but there's something out there anyway.
And there's a way for them to reach you once they get to that website.
Yeah. There's a contact us there too.
Excellent. Well, great. This has been super. Really appreciate it, Brian. And, I look forward to possibly getting a few more of these episodes in with you. The information is just really valuable, I think. And like you said, anything that we can do where we can share information of lessons that we've learned that we can share with our audience and with the listeners, it not only really helps other people out, that they don't have to go through some of the same mistakes we did, but selfishly, at least for me, it makes me feel good when I'm able to do some of those things. And so,
yeah, totally. I appreciate the opportunity because, I get to talk at conferences and things like that, but, being able to go viral, if you will, is a whole different thing.
Yeah. Great. And if any of you listening right now have any questions, any suggestions, any topics that you'd like for us to cover on the Bank Free Blueprint podcast, certainly reach out and let us know. It does help us out a lot if you're able to go to iTunes and write a review if you like what you're hearing. Would love to hear that in one of the reviews. It helps get word out about what we're all working on, the collaborative effort we're working on to get the message out and help everybody become even more successful. So, and if you have any suggestions at all on how we can improve the show, I'd love to hear that as well. So, Brian, thank you very much. And for now, we'll sign off and really appreciate you taking the time.